Today we are putting the spotlight on how some very interesting new fresh breed of fund managers are operating in the market, and faces you may not have seen on the television before. PMS and AIF as a vehicle is gaining ground among the big HNIs, and we are putting the spotlight today with the IIFL Asset Management. They have Mehul Jani as one of the fund managers who I'm welcoming on my show today. Mehul, thanks very much for joining us on our channel today. PMS Corner is the segment which we are having with you, and we have been reporting last couple of months now the way PMS and AIF is gaining ground among the big HNI, and how fund managers are able to take concentrated bets on their philosophy or the kind of scheme which they have drafted. Tell us, in your own fund at IIFL, what is the size of the opportunity you are eyeing when you say that it's the consumer lending opportunity which could be really big for India? Talk to us more about your scheme.
Yeah, thank you for that. So the way we define India, actually we look at India as three buckets of India. So there's India 1, which is the most affluent part of India. So 8% of India's households, 24 million households, are the rich and affluent part of India, which in our mind contributes 60 to 70% of all consumer lending, as well as a lot of the consumer discretionary side of India. These guys have about $8,000 per capita income. And there's anecdotal evidence also if you look at just the numbers that are out there. So if you look at the number of credit cards outstanding, for example, there's 45 million credit cards today. If you look at the number of Demat account holders, it's about 35 million. Right. If you look at any consumer metric or on the consumer lending side or the consumer discretionary side, number of ACs sold, it's basically India 1 which seems to be dominating a large part of this consumption.
Correct.
India 2, which is almost double the size of India 1, which is about $3,500 per capita income, 40 million households. That is largely untapped because banks, NBFCs in general, in the past, they had very limited data on these customers. So they were not able to lend out to these guys. But what we are seeing change, the biggest reform that's happened in the last 5 years or so, is data availability on these customers has improved. Banks and NBFCs are now actually able to reach out using digital methods to even some of the the second rung of the pyramid, the middle class of India, and actually able to offer products there. And therefore, one trend that we can definitely bet on over the next decade is financialization of India 2 and India 3 will only increase.
Right. So, Mehul, if I could just interrupt here, tell us about how exactly are you playing this theme in your fund? Financialization of India, more penetration of consumer consumption in tier 2, tier 3 sites. Just Maruti, for example, the other day was saying that metros are flat, but tier 2, tier 3, tier 4 are having good growth. And many other companies we speak to talk about that. So tell us how you are playing this theme in your portfolio.
Yeah, so I mean there are business models being found across different sectors, as well as even if you just take consumer lending, for example. So you're seeing microfinance grow quite rapidly in the India 3 segment. So you've got companies like Bandhan, Credit Access, Grameen. A lot of these companies are growing in the India 3 segment. In the India 2, you've got affordable housing, which is growing. So companies like Aavas, which we have in our portfolio, are targeting these customers as well. So you're seeing new business models evolve. With electricity now available in most part of India, you're also seeing consumer discretionary, consumer durables, electrical appliances grow. Companies like Crompton, Voltas, etc. will stand to be beneficiaries of these trends. So this is, when you talk to global investors, what do you come to India for? It's not like we have great technology companies. It's not like we have great manufacturing companies. The one thing that India has is a huge population which over time can borrow more and consume more. And in a way, these two sectors are related in some way. So consumer lending as well as consumption are intertwined. And we've seen, the effects of the NBFC crisis over the last 1 year. As soon as the crisis hit, actually consumption has taken a beating as well.
In fact, Mehul, for a moment, I would like to pull up the special graphic which you've got made, checking out your performance. Your scheme has actually managed to perform the benchmark quite nicely in various periods of time. Tell us what has led to this kind of outperformance.
Yeah, so I think it's down to superior stock selection. So we've had a lot of winners from sectors which actually were quite challenged over the last 1 year. So within NBFCs, we had most of the NBFCs that we own are currently sitting at 52-week highs. Even within pharma, we were playing the domestic pharma story, which is again a consumption proxy to some extent. So our pharma stocks are again close to 52-week highs. And even within industrials, we had better stock selection coming through. So it's been down to this, we'll talk about it, the SCDV framework that we
Yeah, in
use.
fact, I'm very curious to know about that SCDV framework.
Yeah.
What exactly and how you formulated this particular kind of a formula?
Yeah, so what we tried to do, when we came in, one of the first things that we wanted to do as a team was, just define what are the kind of companies that we look for and what are the kind of companies that we want to avoid in our portfolios. And clearly, in the long run, if you want to deliver greater shareholder returns, you need high ROE with high growth. I mean, that's the holy grail, right? If you can get high ROE along with high growth. So what we define as high ROE and high growth is north of 15%, because 15% has been the long-term ROE of India, 15% has been the long-term growth in most corporate earnings. So anyone who's delivering higher than that consistently is something that we should look at. And coincidentally, most of the sectors that show up there are in financial services, in consumer discretionary, retail, insurance, etc. So those sectors we want to make as a core. So what we've said is the index has about 40% weightage to the secular bucket. We will always be overweight that. So between 40 to 60% of our portfolio will be in the secular bucket. And quality cyclicals are also important. So I think having the balance between secular, cyclical, defensive is again key, because what we've seen across the street, most managers tend to be very biased towards one of these quadrants. Sure. Some will only focus on value names in the cyclical segment. Some will only focus on quality in the defensive segment. And some will only go for growth and the secular growth drivers. It's important to have a balance because, unfortunately, investors will only come in after your style has performed, and they'll face a down cycle after that.
That's actually, it's also like a winner's curse. If you outperform a whole lot, then you set your benchmark slightly higher. Right. How are you navigating this environment right now? I understand you're in conversation with a new set of investors as well, talking about the new fund which you guys are planning. I'm sure you must be probed quite a lot about the environment we are in. Talk to us the conversations you're having with the client of new investors with whom you are discussing this new fund launch which you are talking about.
Yeah, so so I think you're referring to the AIF which we are in process of collecting money for. So most conversations actually, so we launched an AIF last year as well, and that time things were a lot more uncertain. The NBFC crisis had just hit. And that time the worry was, how bad will things get over the next 12 months. But fortunately, actually, things have panned out quite well for us. Now, actually, the concern is the reverse, where markets are all-time highs. Is this still the right time to invest? And we keep telling investors that just invest for the long run. Over a 5-year period, you will get your returns in that, past data shows us is between 10 to 15% return is what you should expect. Things can be volatile in the near term, but if you take a long-term view, especially on the secular growth type of companies, you should do well over time.
Last question, I'm curious to know a little more about your asset management company. I see very high-quality talent joining your company recently. You have good $3 billion now on the overall fund size.
Yeah.
Talk to us the various segments you're already operating very well in, and what's happening at the company level.
Yeah. So on the public equities team, so myself, Anup and Mayur, we joined last year. But we have a pretty strong team across asset classes. So we have a pretty strong private equity team, where the pre-IPO fund actually was one of the largest. We have a public equities team, which I'm part of, which we're growing the business now. And we've got new guys on the structured credit team as well. We've launched a structured credit fund, and we've got a real estate fund business as well. So it's about $3.2 billion of assets overall. And hopefully that should grow over time.
No, of course, I'm sure. I mean, asset management space is such an amazing space to be in right now. The low penetration, given the low penetration, of course, financialization, which you only spoke about. Yeah. We interact with a lot of funds, and they say that asset management as a business is also a route to play that financialization. In fact, Chris Wood himself was saying that. But I want to get your view a little more on the research which you guys are doing together as a team. Analyzing business cycles.
Correct.
Is this tough for you to be, interacting with companies? What is the feedback you're getting on ground for them? Navigating asset management or managing money in a slow growth environment. Yeah. Give us some feedback there.
Also, one clear trend that you're seeing is growth seems to be slowing down across the globe. So, maybe the return expectations and the growth expectations need to be reset lower. When I refer to the 15% growth number, maybe we all need to get used to slightly lower growth over a period of time because nominal GDP growth is no longer what it used to be. So then that kind of reset seems to be happening, and most corporates also seem to be getting aligned to that fact that maybe the growth needs to be 10 to 12% rather than the 15% mark that we need were budgeting for earlier. And things on the global side continue to remain uncertain, and therefore most of our portfolio actually, if you see, is oriented towards domestic companies. And we tend to just focus on more domestic companies, which we can predict a lot better.
All right, Mehul, on that note, I'll let you go. Thanks so much for dropping by in our newsroom. I look forward to having more conversations with you on the channel.
Sure.
Thank you
for
very
having
much.
me.
Thank you. Bye-bye. That was Mehul Jani of IIFL Asset Management.